name is Junior and welcome back to my channel on how to trade Forex. So in this episode, I'm going to be giving you a full introduction to what Forex is. So if you have heard of Forex and you really want to know how it works, in this episode, I'm going to be giving you all the basics and introduction to Forex. So without further ado, subscribe to this channel, give it a like, and let's go. So what really Forex is? Forex basically stands for foreign exchange, and simply is exchanging one currency for another. So you're exchanging one currency and receiving another currency. That's what really Forex is. For example, if you have traveled to another country, you would need to exchange the money you traveled with into the currency of the country you are visiting. For example, when I visited India, I had to exchange the money I traveled with to the Indian rupee. So I exchanged my dollars to the Indian rupees. They took my dollars and they gave me Indian rupees so that I can be able to use that money in the country I was visiting. And basically, anyone has participated in Forex trading because it's basically exchanging money. Even though you have not traveled, let's say if someone paid you in dollars, let's say in Uganda, you would have to look for a phone, for a Forex bureau or an exchange booth, and then exchange your money from dollars to the Ugandan shillings. So everyone has participated into in Forex trading. And the financial market, the Forex financial market, also referred to as FX, is the largest financial market in the whole world. Not just in the world, but in the whole world. This is the largest financial market with a volume of $6.6 trillion. This is how much is being traded every day in the Forex market. It adds up. It's bigger than the London Stock Exchange market and the New York Stock Exchange market. The New York Stock Exchange market has a volume of $25 billion. As you can see, it doesn't come even close to the $6.6 trillion that is being traded every day in the Forex exchange market. So the Forex market is the largest financial market in the whole world, and there's no other market that comes even close to it. So this is, you can just definitely see that Forex is authentic. There is money in the market. It's all up to we traders to learn the skill and know how we can get this money from the market. So what is traded in the Forex market? You may think it's crypto, you may think it's oil and gas, you may think it's gold, and simply the answer is money or currencies. And remember, the currencies are money. So guys, remember to subscribe to this channel and don't miss out on any content. So currencies like USD, which stands for the US dollar, Japanese yen, British pound, Canadian dollar, New Zealand dollar, and etc. And we don't just buy one or sell one currency. We need to pair one currency and another to form a currency pair. For example, the British pound and US dollar, the US dollar and Canadian dollar, the euro and USD. So remember, if a currency pair it's formed of two currencies, so we pair both of them so we can trade. We can never trade one currency. That's something you should take notice of. For example, the euro USD. So we have here euro and USD. So this is a currency pair, and the currency pair is formed of a base currency and a quote currency. So in our example, we have the euro and USD, and the euro is the base currency and US dollar is the quote currency. So what is the base currency? Remember, our base currency is the euro. So a base currency is the first currency of any currency pair. Let's move on to quote currency. What is the quote currency? So our currency pair right now is euro USD. As you can see, the USD is our quote currency. So a quote currency is the second currency of any currency pair. So you can see that the US dollar is our quote currency. So unlike the New York Stock Exchange or the London Stock Exchange, the Forex market has neither a physical location nor a central exchange. The entire market is run electronically within a network of banks continuously over a period of 24 hours. So this market has no physical location. There's nowhere you can find it. Like it doesn't have a physical location like the New York Stock Exchange that you can find it in New York or the London Stock Exchange. Everything runs on the internet. It's run by the banks in a period of 24 hours every day. And trades can take anywhere as long as you have an internet connection. And if you have not watched my video about what you need to start Forex, you better check it out. The link will be up here to that video, so you check it out and see what you need to start Forex. So when can you take trades? So the market is open 5 days a week and 24 hours a day. So Monday to Friday it's open, and Saturday to Sunday it's closed. So on the weekends the market is closed. So for guys in Uganda, the market opens at 12 on Sunday. No, it opens on Monday at 12 a.m. And when it's closing, it closes on Saturday, on Friday. I think that's Saturday. So it closes on Saturday at 12 a.m. in the morning. Those are the times when the market is closed. The 7 most actively traded currency. So at number 1 we have the US dollar. At number 2 we have the euro. At number 3 we have the Japanese yen. At number 4 we have the British pound. At number 5 we have the Australian dollar. At number 6 we have the Canadian dollar. At number 7 we have the Swiss franc. As you can see on this Forex chart, the US dollar takes up a big percentage of 74.5%, followed by the euro, then Japanese yen, then pound sterling, then Swiss franc, then Australian dollar, and others. So the reason why the dollar is king is because the US dollar is the most traded currency on the Forex market or in the financial markets, and also it has the most is the most traded currency with the most transactions. That's why the US dollar is king. So let's move on to why the US dollar is powerful. So at number 1 is the United States economy is the largest economy in the world. At number 2, the US dollar is the reserve currency of the world. So this is one of the points people don't know about why the US dollar is most powerful. This is like one of the most important points. The US dollar is the reserve currency of the whole world. Number 3, the United States has the largest and most liquid financial markets in the world. For example, the New York Stock Exchange. So our last point, there are very many points, but these are some of the major points. So our last point is the United States has a stable political system. So let's move on to the objective of trading. So this is like the major objective of trading. So the objective of trading is to exchange one currency for another in the expectation that the price will change. As if an exchange rate is simply the ratio of one currency valued against another currency. That's how to read a Forex quote. Currencies are always quoted in pairs, such as the pound and USD, USD and JPY. And the reason they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling another. Here is an example of a foreign exchange rate for the British pound versus the US dollar. So as you can see, we have for you to be able to buy 1 pound, you need 1.51258 dollars. So you need $1 and 5 cents 12558. So for you to exchange 1 pound to US dollar, when you exchange the 1 pound, you receive 1.51258 of the US dollar. So the first listed currency to the left of the slash is known as the best currency. That's the pound there, you can see. While the second one on the right is called a quote currency, which is the US dollar, as you can see up here. So when you are buying, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the best currency. In the example above, you have to pay 1.51258 US dollars to buy 1 British pound. And while selling, The exchange rate tells you how much you have to pay in units of the quote currency to sell one unit of the best currency. In the example above, you have to pay 1.51258 US dollars to sell 1 British pound. I guess that example is very simple. When you're buying, you will need 1.51258 US dollars to get 1 pound. Then same to the selling. That's how much you need. So let's say Euro USD. Another example, Euro USD. If you buy Euro USD, this simply means that you are buying the best currency and simultaneously selling the quote currency. In simpler words, buy Euro and sell Euro, or sell Euro, sell USD. So in simpler words, it's buy Euro or sell USD. So as you can see here, the Euro is our best currency and USD is our quote currency. So you would buy the pair if you believe the best currency will appreciate, in brackets, gain value relative to the quote currency. So, or you would sell the pair if you think the best currency will depreciate or lose value relative to the quote currency. So let's move on to long, short, bullish, and bearish. So these are the terms. These are some of the terms we use in the forex market. These are some of the terms you need to take notice of, because these are the terms professional traders use: long, short, bullish, and bearish. So guys, remember to subscribe to this channel and turn on all your bell notifications so that you don't miss out whenever I post a new video. So what is long? So basically, when you buy, you are going long. So whenever you place a buy order, you are going long. Long means buy. When you sell, you are going short. So meaning when you sell, you are going short. Whenever you place a sell order, you are going short. So whenever, let's say in my Telegram group, I send out a signal, I tell you I'm going long on USD JPY. It means I'm buying. Same to selling. If I say I'm going short on the USD JPY, it means I'm selling that currency pair. So long equals to buy and short equals to sell. So what is bullish and bearish? Bullish basically means that you believe a currency pair will go up, so you believe it's bullish. It's on a bull run. It's going to go up. That's what bullish means, or a bulls. And bearish, on the other hand, means that you believe a currency pair will go down, so you believe it's bearish. It's on a bear run. It's going to go down. So bullish is an uptrend. You can use the term uptrend. Then bearish, downtrend. So as you can see, bullish upside we mean up, then bearish we mean down. So we come to bid ask spread. These are some of other terms, some confusing terms we have in forex, but they're very easy to understand. So all forex quotes include two-way price. The bid ask, the bid is always lower than the ask price. The bid is the price in which the broker is willing to buy the best currency in exchange for the quote currency. This means the bid is the price at which you, as the trader, will sell to the market. The ask is the price at which the broker will sell the best currency in exchange for the quote currency. So this means that the ask is the price at which you will buy from the market. So the difference between the bid and ask price is properly known as the spread. And the spread, in easier terms, I can say the spread is the share that the blockage takes from you before you make profits or any loss. This is how much they take from you. So the difference between the bid and ask, the ask price, is properly known as the spread. As you can see here, we have Euro USD, we have the bid and ask. The bid is 1.4502 and ask is 1.4505. So on the Euro USD quote, the bid price is 1.4502 and the ask price is 1.4505. If you want to sell euro, you click sell and you will sell euros at 1.4502. If you want to buy euro, you click on buy and you buy euros at 1.4505. So if you want to sell euro, you press on the sell, and you sell the euros at 1.4502. And if you want to buy euros, you press buy order, and you buy euros at 1.4505. So let's move on. How do you know when to buy or sell? There are two ways to analyze the market charts or the market charts and know when to buy or sell. So the first way is technical analysis. The second way is fundamental analysis. So fundamental analysis. So each currency belongs to a country or a region. So Forex fundamental analysis focuses on the overall state of the country's economy, such as productivity, employment, manufacturing, international trade, and interest rates. For example, the Euro USD. In this example above, the euro is the base currency, and that's the bias for the buy and sell. So if you believe the US economy will continue to weaken, which is bad for the US dollar, you would execute a buy Euro USD order, and by doing so, you buy the euros in expectations that they will rise against the US dollar. As simple as that. So if you believe that the US, because remember this is a currency pair, Euro USD, so it be, and they've told you up here the Euro USD is the best currency, that's the bias of for the buy or sell. So if you believe that the US economy will continue to weaken, which is bad for the USD, you would execute a buy Euro USD order, and by doing so you bought euros in expectation that they will rise versus the US dollar. And another example, if you believe that, now this is for the sell. So if you believe that the US economy is strong and the euro will weaken against the US dollar, you would execute a sell euro USD order, and by doing so you would sold euros in expectation that they will fall versus the US dollar. So this is the example of how do you buy and how do you sell by using fundamental analysis. So if you believe the euro USD you weaken, then we shall place a buy order on the euro USD. But if you believe the US economy is strong and the euro will weaken against the US dollar, so you would execute a sell euro USD order, and by doing so you sold euros in expectation that they will fall versus the US dollar. As simple as that. So as forex traders, we rely on news sites to update and notify us when events occur, such as when President Trump does his speech. Knowing that dates of key events will help you avoid trading during those volatile moments. And by volatile, I mean this is a time when the market is very fast or very slow. So knowing this fundamental analysis helps you it helps you avoid trading during those volatile moments, or will help you keep aware so you know what to expect from the market. So this is one of the most important sites we use. It's called Forex Factory. On this hand here, you can see Forex Factory. This is where they show us economic events that happen daily from Monday to Friday. So here you can have the economic events with the time and the data about if it's unemployment, they'll give us previous unemployment, then actual unemployment, then forecast and everything. So those red colors and everything, they all represent volatile. So these are the key event times and the economic events that will happen. Let's say today, they'll all be lined up here with the time when they will happen. And on this other hand, we have the news event articles. So that's where the articles come out. Now, let's say if something has just happened and we didn't know about it, it will appear on this page. So our site is called forexfactory.com. But there are also other websites that you can use, like investing.com. It has an economic calendar. Same to all blockages have most of the blockages I know, they have economic calendars where you can access all the economic events that will happen during the week or from Monday to Friday. So this one's called Forex Factory, or you can use. Uh, so when you're on the economic calendar on the forexfactory.com or on the investing.com, you find economic events that have these colors. The first color is high impact. It means high impact. That event is going to have an impact, a very high impact on the forex market. For example, we have NFP, we have central bank meetings, we have unemployment, we have consumer price index, we have gross domestic product, and unplanned forex news on this one. That's for the high impact. Then on medium impact, to have also an impact on the forex market, but not as much impact as on the high impact. Then on low impact, these are also economic events that don't really drive the market. They have less volatility on the market. And the non-economic one, those are the ones that don't drive the market totally. So when these events happen, these ones, they don't affect the market so much. So being able to know all these, it will help you know when to be in the market. It helps you to know when to be in the market when the market is volatile or not volatile. So it's very important to know about fundamental analysis. So let's move on to the technical analysis. So when we talk about technical analysis, this is basically charts. We are analyzing charts. So technical analysis is the framework in which traders study price movement. The idea is that a person can look at historical price movements and based on the price action can determine at some level where the price will go. So the main evidence for using technical analysis is that theoretically, the current market information is reflected in price. Now that you have heard of the saying, history tends to repeat itself. So whatever happens in the market has ever happened. So it's a matter of just going back to the charts, like you increase your time frames to daily time frames, then you go back and see what happened on this date and date. So these things that happened yesterday will happen again in the forex market, but based on we looking for information on where the price did this and this did this, that's where we can know when to enter a buy or a sell using technical analysis. So that's basically what technical analysis is all about. So technical analysts look for similar patterns that have formed in the past and will form trade ideas, believing that price act the same way it did before. So here, these technical analysts or with the traders will just look at the charts and look for some different patterns that have already happened in the past and will make trade ideas and based on where the price will go. So technical analysts use charts because they are the easiest way to virtualize historical data. You can look at past data to help you spot trends, patterns, which would help you find some great trading opportunities. So these are some of the types of charts we have. We have the line chart, we have the bar chart, and the candlestick chart. So we shall start with the line chart. A simple line chart draws a line from one closing price to the next closing price. When strung together with a line, we can see a general price movement of the currency pair over a period of time. Here's an example of the UUSD. So this is a line chart. It's just, as you can hear, a line chart. So followed by a bar chart. A bar chart is more complex. It shows closing prices while simultaneously showing opening prices as well, and the highs and lows. At the bottom of the vertical bar indicates the lowest traded price, as you can see here. For the time period, while the top of the bar indicates the highest price paid up there. The horizontal hash on the left side of the bar is opening price, and the right side of the horizontal hash is the closing price. Here's an example of the bar chart. This one you see here. But we don't, a few people use the bar chart and line chart. Most people use the candlestick chart. This is everyone's favorite. Like, this is very easy to understand. These bodies, those big bodied things you see, the red and green, those things tell a story. By just seeing that, I can know that there is high buying pressure, and by just looking at this one, I can just see that there is high selling pressure. So these are candlesticks. So Candlestick charts show the same information as bar chart, but in prettier graphic format. Candlestick bars still indicate high and low range with vertical line. However, in candlestick charting, the larger block is in the middle indicates the range between the opening and closing price. So a candlestick consists of two things, the body and the wick. The body is that green thing you see. Then the small sticks are called wicks. So the body is that green and red thing. So the body is the central block and shows the open and the close. So the body is this one. It shows the open down here, as you can see, open there, then the close there. The wicks show the low and high. So the wicks are these lines. They show the low and highs. Candlesticks are easy to interpret and are good plus for beginners to start figuring out how Forex chart analysis. Here is an example of the candlestick chart. As you can see, these are candles. What is a pip? A pip is the unit of measurement to express the change in value between two currencies is called a pip. So here you can see we have Euro USD, and remember, Euro is our base currency and the USD is our quote currency. So we have 1.1051 and 1.1050. So if Euro USD moves from 1.1050 to 1.1051, that 0.0001 USD rise in value is 1 pip. So you can see one here we had one, so the rise in the US dollar rose by 1 pip. So we have here 1 pip change. So a pip usually is the last decimal place of a price quote. Let's go back here. You see this one here and there is 0 here. So this change to 1 is the last decimal place, which we call a pip. Most pairs go out 4 decimal places, but there are some exceptions like the Japanese yen pairs. They go out 2 decimal places. So let's move on to the lot size. What is a lot size? The number of currency units you buy or sell is called a lot size. There are standard lots, there are mini lots, micro lots, and nano lots, as you can see down there. So before I go to the leverage, I'll first come back to the lot size. So the lot size in simple terms. Let's jump on to leverage. So leverage is simply the ratio of the amount capital used in a transaction to the required security deposit. Leverage is the ability to control large dollar amounts of a security with relatively small capital. So you can, with leverage, it helps you trade more dollar amounts or bigger accounts with just small money in your account. So leverage varies dramatically with the different brokers that you're using. So ranging from 1 to 1, 500 to 1. For example, if you use a leverage of 1 to 300 and you had a capital of $1 in your account, you would take a trade worth $300. But however, it's a double-edged sword, and yeah, it basically allows you to invest more than what you have in your account. So I suggest personally, I suggest a 1 to 300 ratio leverage. It helps you to make more money and while risking less. So 1 to 300 is the leverage I use, and that's what I suggest you should use. We jump onto the major and minor currencies. So the 8 most frequently traded currencies, we have the US dollar, the euro, Japanese yen, the British pound, the Swiss franc, or the CHF, the Canadian dollar, New Zealand dollar, and Australian dollar. These are the most traded currency, or the majors. There are 8 in number. And others are called minors. So we jump onto margin. If you open a new margin account with the Forex broker, you must deposit a minimum amount with that broker. This minimum varies from broker to broker and can be as low as $100 to as high as $100,000. So each time you execute a new trade, a certain percentage of the amount balance in your margin account will be set aside as your initial margin requirement for the new trade. So every time you place a trade with a lot size, let's say if you place a trade with a lot size of For example, this is one of my trading accounts. As you can see, I'm making profits, and my balance is $274, and my equity is $445. So, for you guys who don't know equity, equity is balance plus your profits. So it will equal up to your equity. So this is how much now I have in my account, $445. And you can see my margin is $39. So this margin is money removed from my balance, my $274. In order to place these trades here, you can see the US dollar and South African rand. So for me to be able to place these trades, $39 was removed from my account, from my main balance, to place these trades. So this is what we call margin. So my margin here is $39. Yeah. So as I have showed you in the screenshot of my trades I took, I had a certain amount of money had to be removed from my main balance in order for me to open those trades I opened, and a certain amount is removed, and a certain amount is called a margin. So the margin is removed according to the lot, the trades you have opened and how big their lot sizes are. So as I showed you in my account, I had $274, and $39 had to be removed as the margin because my trades had small lot sizes. So let's move on to the market orders. A market order is an order to buy or sell at the current market price. For example, the Euro USD is currently trading at 1.2140 and the ask price is 1.242. If you wanted to buy at this exact price, you would click buy and your trading platform would instantly execute a buy order at that exact price. So if you wanted to buy, you would press buy on your MetaTrader or in the on trading platform that you are using. If you ever shop at Amazon.com, it's kind of like using a one-click ordering. If you like the current price, you would click once and it's yours. It's just same as Forex. So if you wanted to buy at a certain price, and let's say, as I've told you, Euro USD is currently trading at 1.2140 and the ask price is at 1.242. If you wanted to buy at the exact price, you would just click on the buy and you would execute the buy order at the exact price. So let's move on to the limit orders. So a limit order is an order placed to buy or sell at a certain price. This is like it helps you to place orders, either a buy or sell order, like future. These are like future orders. I would call it a future order. For example, Euro USD is currently trading at 1.2050. You would go long if the price reaches 1.2070. You can either sit in front of your monitor and wait for it to hit 1.2070, at which point you would click a buy market order, or you can just set a buy limit at 1.2070. Then you would walk away from your computer and attend your ballroom dancing class. So yeah, basically they're telling us if you wanted to buy when price reaches 120.70, you would sit in front of your computer and wait until price reaches 1.2070, or you would rather place a buy limit, and then when price reaches 1.2070, the price, the market or the trading platform you are trading on would automatically execute your buy order and the market will start going your way. So it doesn't need you to be on your computer every time. So this is what the buy limit helps us. Same to the sell limit. So if you want to buy at a certain price, you can just set it at the price, then you can place your take profit and stop loss. Then same to the selling part, sell limit. You can set a sell limit at a certain price. Then when price reaches that part, it will just execute itself. As you can see here, we have the buy limit here, the green line. So let's say if we placed our buy limit at the green line exactly, so price came and touched that, they started going back up. Same to the sell limit here. So meaning that red line is our sell limit order. So meaning when price was coming up and touched our red line, they started coming back down. So that's what a buy limit and sell limit mean. So let's move on to the stop orders. A stop order is a limit order linked to an open trade for purpose of preventing additional losses if price goes against you. So this is more of a stop loss. So a stop loss order remains in effect until the position is liquidated, or you can cancel the stop loss order. For example, you went long, which means buy, on your USD at 1.2230. To limit your maximum loss, you set a stop loss at 1.2200. This means if you are dead wrong on a signal or on a trade on euro, and then the euro USD drops to 1.2200, instead moving up, your trading platform would automatically execute a sell order at 1.2200 and close out your position for 30p plus. Yeah, so here basically, when you don't want to lose more money in an account, if let's say if your prediction was wrong and market goes against you, so you set a stop loss at a certain price, and when the market touches that, it will automatically close your trade in a loss, but it won't blow up all your money. So let's move on to the Forex trading sessions. So the market is open 24 hours a day and 5 days a week. So we have 4 main market sessions. We have the first one is seeding session, followed by the London session, the New York session, and Tokyo session. So this is our trading session time zones. As you can see, the seeding seeding time session, it opens at 21 and closes at 5 in the morning, and Tokyo opens at 23 in the night and closes at 7. Then the London session opens at 7 in the morning and closes at this is 6 in the evening. Then the New York session, it opens at 12 midday and closes at 20, which is 7 in the evening, and this is GM time. So for if you want to convert this time to your country's time, so I don't know what country you may be in, but basically just go to www Forex time zone. As you can, there's a link down here. Go to www.forex.timezoneconverter.com and convert these time frames, these time sessions to the time of your country. So this is Forex trading session according to the Ugandan time. So if you're in Uganda, I made this easy for you. So we have this Frankfurt and London. This is the same. This is the same session, the London session. So the London session opens at 10 a.m. Ugandan time and closes at 6 p.m. in the evening. So, and the New York session opens at 3 p.m. in the evening and closes at 11 p.m. in the night. And the seeding session opens at 1 a.m. in the morning and closes at 9 a.m. in the morning also. So we have Tokyo session, it opens at 2 a.m. in the morning and closes at 10 a.m. in the morning. So the best times to trade Forex. We have the London session, the London and New York overlap. So this is the time, this is the busiest time of the day as traders from the 2 largest financial centers trade. So this, we mean London and New York traders. So this is the time where the busiest time when traders from both London and New York center market trade. So it is during this period of time where we can see some big moves, especially when the news reports from the US and Canada are released. The middle of the week typically shows the most movement as the PIP range widens for the most of the major currencies. Yeah. So the best time to trade is when the London session and New York session are open. That's the best time. That's where we can find volatility in the market. Other than other sessions, we won't find much volatility or more volatility like in the London and New York session. So worst times to trade Forex. Sundays. Sundays are the worst days to trade Forex because the market is closed and everyone is sleeping and enjoying their weekend. Fridays, so liquidity dies down during the later part of the US session, so we don't trade on Fridays, and you don't want to be caught up when the market closes on Friday. You don't want to be caught up with a trade. Another thing, holidays. Holidays, everybody is taking a break from Forex. So, as everyone is taking a break from the Forex, also take a break because there won't be any volatility in the market. You won't make any money during holidays. Major news events. Yeah, this one you wouldn't want to get into a way when there is major events that have happened, which are, let's say, a high volatility or low volatility. So if they're high volatility and you trade a certain currency, let's say the Euro USD, and then NFP drops. NFP is non-farm payrolls, which indicates how many jobs have been added to the US economy and or how many jobs have been removed, so or how many people have lost their jobs. So when this news event happens, it tends to drive the market so high. So if you're into that market during that time and you don't know where the market is going to go, it may you may lose some money during that time. So these are the worst times to trade, and you don't need to be in the market during these times. Now that you know how to trade Forex and or you know how Forex works and you know the basics, I recommend you to open an account with a blockage called Templar FX. They're very good blockage. They have good spreads. They have a good leverage they offer to you when you deposit money. So I recommend that you open a demo account with them, not a real account. You need to open a demo account so that you first practice before jumping to the real money. So you would need to first practice until you are confident enough that you can trade now the real money. So this is called Templar FX. All you have to go do is come here to members area, and then you log in if you have an account. If you don't have an account, you come down here to join members area. Then you sign up, full name, email, number. Then they verify your email or your account in 7 to 6 hours. Then you will then open a demo account and connect it to your MetaTrader 4, then start trading Forex. As easy as that. So guys, I hope you enjoyed this video about Forex, and I hope now you know how to get started with Forex and you know what Forex really is. So make sure to hit the like button, subscribe to this channel, and share it with all your friends that you know they are lacking in Forex. See you in my next video.